Don't spend more than 20% of your income on a car. Follow the 24-10 rule while buying a car. These two pieces of advice sound smart, logical, and sensible, right? But unfortunately, this does not work well in India. Because buying a car isn't just a money move, it's an emotional milestone and it's a big family decision. And when you buy a car, it is not just your happiness that matters, but your entire family's happiness matters. Your spouse, your kids, your parents, your grandparents, everybody. So the Western formula to budget our cars or take EMIs becomes irrelevant in Indian societies. So instead of following some Excel sheet blindly, we will zoom out and learn about 3 things nobody tells you before you can buy a car. And let's face it, once we buy a car, it stays with us for 8 to 10 years unless you're a motor enthusiast. So the question is, how do you budget for a car so that you can comfortably afford it? Please note, I'm not getting into the debate of which car type, petrol or diesel, which brand, etc. This is something you need to figure out. I'll just stick to the car financing part. As I mentioned earlier, there are car budget formulas to help you make decisions. But these formulas are directly imported from the West and they lack complete cultural and contextual awareness of Indians buying a car. Hence, these formulas are good in theory but fall flat when it comes to practicality. These formulas are fully ignorant of your family's needs and happiness. They are highly rigid and short-sighted as they factor in your present-day financial condition and they are not forward-looking. A person's financial situation is not static. It evolves over time. Your financial situation may change next year and you may get a raise, you may get a bonus, or you may even change jobs for a bigger pay. Given these changes, you don't want to be stuck with a car that you would want to sell within the next year or 2, and then buy another car just because your financial situation has changed. Hence, it's always prudent to foresee 2 or 3 years into your financial future and buy a car that you think will be good for you and your family, not just for 1 or 2 years, but for at least 5 to 8 years. Let me give you an example. If your post-tax take-home salary is 15 lakhs per annum, then according to these car budget formulas, you may end up with a car which may cost you about 5 to 6 lakhs. It's fine if you can find a car within this budget, but I would presume the chances of that happening are low. In most cases, we step outside our budget and buy cars to accommodate all the needs of our family members. So if there are no formulas for buying car, what should be your approach? Well, the same good old approach applies to all financial decisions. Common sense and a few smart financing options. That's it. All the options that I'm going to discuss are things I would probably do for myself, and they're in the same preferred order of financing. Let's approach the common sense part first. Now, just because I said you need to look at your immediate financial future and buy a car that may be outside your comfort zone, does not mean you end up buying a fancy fuel-guzzling sports car that costs 5 times your annual CTC. That would be outright stupidity. Rather, if your post-tax take-home salary is 15 lakhs per annum, then it's okay to aspire to buy a car that would cost about 8 to 9 lakhs, keeping your family in perspective. This is acceptable. The question is, how should you finance this car purchase? One of the most common things people do is to take a car loan, which is okay and we'll get to that in a bit, but a car loan should not be your first option. Your first option is to look at your savings. The idea is to see if you can buy a car cash down, outright purchase, and avoid a loan completely. I know this may not be intuitive. I know you would not want to break your investment to buy a car which is a consumption item. But in my opinion, breaking an investment, maybe that FD, maybe that mutual fund, is a far better decision than taking a car loan. The reason is simple. A car loan creates a financial liability on you. As far as possible, you should try to lead a loan-free life because this is less stressful financially and mentally. So if you have an investment, see if you can use it in part or in full to finance your car purchase. This works particularly well for young people as they have a lot of time to rebuild their assets. Speaking of assets, here is another alternative. Consider this as an extension to option 1. Some of you may not be comfortable with liquidating your assets for tax reasons, or maybe you do not want to disturb the compounding effect. You can, in such circumstances, keep your assets as it is and take a loan against your mutual fund, stocks, or FDs. This is also called a last loan. But this is slightly nuanced and you need to understand its advantages and disadvantages clearly before opting for it. A last loan to finance a car purchase is unconventional, and I would advise this only if you have the confidence in managing your cash flows well. Loan against mutual funds or stocks comes at a premium compared to a regular car loan. However, the biggest advantage in a last loan, you only pay interest every month. Let me give you an example. Assume both a traditional car loan and a last loan is available to you at 10%. If you were to take a 5 lakh loan at 10%, then your monthly interest payment would be 4,166 in a last loan compared to 16,134 in a traditional car loan. However, at the end of 3 years, you will have to repay 5 lakhs in a last loan, which is not the case in a regular car loan as the EMI factors in principal repayment. Also, if you tally the total interest you would have paid, then in a last loan, you would have paid a little more interest. So having said that, when should you really opt for a last loan? Well, when your credit score is really bad, as a result of which your car loan interest rate is very high, or when you want a lower monthly payment so that you can continue to invest in your SIPs and build your portfolio, or when you want a lower monthly financial commitment, or when you know your funds and stocks are performing well and you do not want to sell them just yet. In a last loan, your assets are with you but pledged to a lender. This means that you're still entitled for capital appreciation and dividends from your investments. But the loan itself is market linked. If in case the markets take a severe hit, you will have to repay sooner than you planned. Most people who take last loans also try to repay the principal quickly as and when they get their yearly hikes and bonuses. My advice, take a last loan if you have assets and you know how to manage a last loan well. Alright, what if you don't have any assets to either sell or take loan against it? How would you finance your car? Well, in this case, here is option 2. I would suggest you look at used car market once. Financially speaking, this is a smarter option. The general car depreciation trend indicates that most cars lose up to 40 to 45% of their value in the first 3 years, and from then on, the rate at which the car depreciates decreases. What this means is that if a car is priced at 10 lakhs, then the same car in 3 years will be available to you at 5.5 to 6 lakhs. However, from the 3rd year onwards, the car will lose value slowly. Meaning, maybe in the 4th or 5th year, the car's value will be roughly about 4.75 to 5 lakhs. So financially speaking, if you're buying a car that is 3 or 4 years old, then you are likely to get a good rate, but at the same time you won't lose much if you were to sell it in few years. But remember, never ever take a loan to buy a pre-used car. That would be a financial disaster. Alright. What if you don't feel comfortable buying a used car? Well, if you neither have any assets to sell or take loan against, and you are neither comfortable with a used car, then your only option is to take a car loan. And this is the 3rd option. If at all you're forced to take a loan, my personal advice, try and take this loan from family members who won't charge you an interest. But remember, mixing money and relationship can be really tricky. So you need to treat this loan on high priority and try and repay well in advance so that you can continue to maintain a good relationship. If none of the above work, then yes, you will have to take a loan from a bank or an NBFC. You see, a car loan from a bank and NBFC is my last option. But if you have to take it to procure a car, then there is nothing much you can do about it. Here are a few things to keep in mind before taking a loan. Make sure your loan tenure is not more than 3 to 4 years. Remember, no matter how emotional a decision to buy a car is, end of the day, it is a consumption item and not an investment item. Unless, of course, you're buying a car for commercial purchase. There is no point taking a long-term loan against it. At this stage, it becomes a bit tricky. You really need to figure out how much loan you can afford. Most importantly, you need to ensure you have at least 25 to 30% cash as down payment. As I said, always go for 3 to 4 years loan repayment tenures. If you opt for 7 to 10 years, then I'm sorry you cannot afford a car just yet. You may have to wait it out before you take a plunge. Look for banks that offer minimum pre-closure charges. Some banks charge 3 to 4% on the outstanding principal amount when you pre-close a loan. Some charge 0. So please make sure you do this due diligence. Always do prepayments whenever possible and reduce either your EMI or the loan tenure. And lastly, when you're factoring in your monthly EMIs, ensure you factor in not 12 EMIs but at least 14. This extra EMI helps you smoothly navigate your yearly insurance and servicing costs. I hope you found this video useful. If you have any tips on smartly financing a car, then please do share it with us in the comments below. I'll see you guys in the next video.